Moody's says it may put America's AAA credit rating on review, that is, unless it can make progress on increasing its debt ceiling by next month. The agency said there needs to be a, quote, credible agreement on substantial deficit cuts in order to support a continued stable outlook. Now, we're also expecting a key U.S. jobs report later. It's predicted to show further cooling in the recovery. Economists expect a much slower pace of hiring. They estimate a gain of 165,000 new hires in May. That's far less than the 244,000 the month before. Across America, 9% of adults are out of work. While the figure has been falling in the past year, it ticked up last month. The number of jobless varies widely from state to state. The worst of the problem is in Nevada. Its unemployment rate remains the highest in the country at more than 12%. Now let's get more analysis on both issues. I'm joined by James Knightley, a senior economist at ING Financial Markets. Thank you so much for joining us. What are you actually expecting out of the U.S. data today? We did see a little bit of softness earlier on in the week in terms of the private sector data, but also in terms of manufacturing. Does that make you a little bit more nervous going into this jobs data today?
Yeah, it does. The market has been scaling back its expectations for today's number. This time last week, they're looking for a number close to 200,000. As you say now, that is back down towards 165,000. We've probably been a little bit more aggressive, now favouring a number perhaps closer to 100,000 in terms of the actual headline figure. And as you say, all of the numbers that we've been getting over the last week have been disappointing. The ADP suggested private payrolls growth was far slower than expected. The ISM manufacturing report suggested that the labour market in that sector is the weakest for about 10 months or so. So those sorts of numbers do make you a little bit more cautious, and that's why the market has been scaling back its hopes for today's jobs number.
Yeah, and James, you know, we've had, of course, every day we talk about the debt crisis in Europe, how concerning that is for investors, how much risk aversion there is around that. Is there a real concern that actually these bond vigilantes will leave Europe and focus on the U.S.? We have similar problems in the U.S., and it seems like the government isn't really doing all it can to address these problems.
Yeah, and that's, I guess, you know, the concern is that the Moody's announcement today is going to fuel those fears even more. So there is a lot of concern out there. I still think that the US recovery story can pick up in the second half of this year. I think a lot of the weakness that we've been getting has been relating to higher energy costs. I think also there has been perhaps some more disruption from the Japanese situation than people were initially believing that they might be. And those sorts of factors are also adding to the mix and adding to the uncertainty and adding to significant market volatility.
But will we talk about a U.S. debt crisis like we have here in Europe about the European economies? They have 8 weeks to try and get up the debt ceiling, and so far there's absolutely no movement in that.
That's right, and S&P started this whole process off a few weeks ago when they initially said that they were perhaps looking at the possibility of a threat to a reduced outlook on US debt. And now Moody's have followed up as well. So clearly they are putting pressure, and I think that will help. If it can bang heads together and we can get some sort of agreement over the next few weeks, then that will be successful. But I think, you know, it's inevitable that something will have to happen, because otherwise the impact on the US labour market is going to be devastating, because you are going to see massive public sector job losses to cope if there is that hit to the debt ceiling and we can't get a negotiation out of this.
And James, again, we have seen a little bit of softness in a lot of the manufacturing data coming not only from the US but also from China and a lot of the emerging economies, and of course here in Europe as well. If we have a lot of softness in the US, what does it mean for the world recovery in general?
Well, it is concerning, but as I said, I think a lot of it is down to the lagged effects from higher energy costs. We've now seen in the US gasoline prices fall by about 10%. That's going to help keep more money in US households' pockets and therefore help theoretically to boost sentiment and spending power. I think the big concern is that businesses in the US have been hit by the revenue side from this, from households spending more, households spending less, but also their costs have been increasing as well because they're having to pay higher energy fuel. So profits are being squeezed, and that is also relating to reduced payrolls hiring, and I think that's another story for today.
Yeah, certainly it's a very concerning picture. James Knightley, thank you so much for joining us.